What's going on, everybody? It is Atasha Watkins, your favorite realtor, and I'm here with Peter Karlin, the greatest man, the greatest loan officer in the business, one of my favorite people in the world. Thank you so much for this weekend, actually, as well. I had a great time.
My pleasure.
Awesome,
My pleasure.
awesome. So tell us a little bit about what you do, a little bit about the game.
So I'm a mortgage broker. As you know, I was a banker. I was a mortgage banker for about 10 years. And the difference between a banker and a broker is that a banker or mortgage banker works for a particular bank, for one particular lender. As a broker, I don't work for any bank, but I work with a number of different lenders, right?
Okay.
So it's kind of cool because for many years, I mean, when you work for one lender as well, they have, like I worked for a lender before, and we were able to broker out to other lenders.
Okay.
But being a broker, I now have access to wholesale pricing, and I have about 50 different lenders that I work with.
Okay. So what does that actually mean? What does like wholesale pricing mean? How does that differ?
I tell people I'm sort of like the Costco guy. I mean, wholesale. You go to why do you go to Costco and BJ's and Sam's
Get
Club?
the best price that
You
we
get the
can.
best pricing, right?
Definitely.
The pricing's amazing. So that's pretty much what I mean. When you come to a broker, we have, if you go to a broker, a broker shop that has good connections to a lot of lenders, you have a lot of different choices. And wholesale means getting, really good rates. And it's so competitive right now, especially
100%.
with rates being so high. You better have good rates or people are not going to stick with you. People shop around and they look around and they want the best deal, and you better be able to come through.
Yeah.
One of the reasons why I moved to the broker world is because I was getting beat by a local broker, and that local broker actually left his brokerage to come over and work with our brokerage. So
you stole them. You stole them from the competition.
I sold them. It was an easy sell because the broker that I work with is the name. It's a funny name. I don't want to say it's a funny name. It gets a lot of reaction, right?
Are you
People
going to
say,
tell us?
Oh my God, what a different name, but it's memorable, and people are going to know about us because we're growing really super fast. But it's a wonderful company. The name of the company is Go Rascal. Go Rascal. Yeah.
I know it caught me off guard when you first said it, but I think that that's great marketing within itself. You get a laugh out of everybody, and it sticks with you. You can never go.
Joshua, exactly. And I think that was the intent. Like the owners, Scott Valens and David Williams, I think, they hired a marketing company to come up with the name. And it was they specifically wanted to have a name that was not mortgage related.
Yeah.
So the marketing company came up with, or one of the names that stuck with David and Scott was Go Rascal, because it does create a reaction, and it is so memorable.
It's bringing me back to my childhood. I'm remembering the Little Rascals and everything like that.
My brother,
I just dated
for those
myself.
Of you who remember the Little
I just
Rascals.
dated myself, man. I just dated myself, definitely.
Yeah, well, you and me both.
So, question: why is your guys able to get the best rates out there?
I'm sorry, the best?
The rates out there.
The rates. Well, again, you came to visit UWM, United Wholesale Mortgage.
Yeah,
right?
we could. Yeah.
Let me tell you, those guys are crushing it. I mean, Matt Ishbia, my hat's off to you and your staff. They just hired 500 people, and they're hiring more next month.
Yeah.
It's crazy. Why are they doing that? They're actually gearing up. They're scaling up for the refi boom that will be coming in short order. It's coming, right?
Yeah.
But UWM is the number one lender in America. It's the number. They did over 127 billion with a B loan volume last year.
Yeah,
Yeah. They surpassed the other big company. I'm not going to mention the name, but,
those who should not be mentioned, right?
They're the number one lender, man, and they are smart because they give really competitive pricing, along with a lot of other lenders that I work with. You know, I don't. They're not. UWM is not, as much as I love them, they're not the only game in town. But there are some other wonderful, wonderful lenders. But UWM does have great pricing.
Yeah.
Does have great pricing and loan products as well.
And I think that's what separates the banker from the broker is that you're able to shop around their loans and everything like that, right?
100%. I was getting beat, and I was with a very big lender, a very popular lender for 4 years, and on one of the number one. Actually, I was on the number one producing team in that company, and I was getting beat. I was getting shopped, and I was getting beat, and I was just if you can't beat them, join them.
100%.
You know that, right? So,
yes, sir.
So I joined them, and the broker channel is it's a good channel, man. It's a good channel, and especially now when you have to be super competitive. I think it's the place to be. I think it's the place to be.
And I think for me, that's why I bring my 90% of my deals to you, because I know that they're going to get the best rates. I know you guys have amazing programs as well, and I know it's going to get done fast.
Thank you.
You know,
Thank you. Yeah, the average close time at UWM is, I think it's about 17 days.
That's crazy.
17 days. I mean, it really is crazy. And they can do stuff, one of the things that I was always told that, when you become, if you're a mortgage broker, you have less control. You can't talk to an underwriter. You don't have control over the deal. That is so not true. It is so not true. I will tell you that, I frequently have conversations with underwriters.
Okay.
They are super accessible. No, I think it was a great move that I made. It just happened this January. I just moved over in January.
Awesome. So I think why everybody's here, as everybody's excited about that 1%.
The 1%.
Yeah. How do we get a home?
Down?
A home with 1% down.
So UWM, and it's UWM that is really promoting this. It's their product. And it's 1% down. Now, it's not for everybody, okay? So you have to be, there's what we call an area, a median area income limit, right?
Okay.
So each area in the United States has their own median income, right?
Okay.
So New York City is higher than other places, and right. So, but you have to look at, and there's an income lookup tool. There's an income lookup tool. Freddie Mac has a tool. I could, give everybody you could just Google it, but I can give everybody the link if they need the link. But you look up the median income limit, and you have to be 80% of that. There's a number of qualifications, right, that you have to have, but it's similar, and you don't have to be a first-time home buyer, by the way.
Oh, wow. Yeah,
a lot
that's
of people
big.
think you got to be a first-time home buyer. You do not have to be, and but you got to be 80% median income, and then you can get up to and including $4,000, right?
Oh, wow.
Right. So if it was a 200, see, it's not so much a New York City product, because a lot of our homes are more than, for instance, if the home was 200,000,
Okay.
the home was 200,000, and let's say UWM gives 2%, either 4,000 or 2%, 4,000 or 2%, whichever is more, whichever is less or more. I forget.
I think it's less, right?
Whichever is less, right? So if it's 2%, if it's 200,000, 2%, that would be $4,000. They give you $4,000, and you'd have to pay 1%.
Got it.
Did I do that right? Did I say that right? I'm not sure.
No worries, but
I'm not sure.
We'll have everybody touch base with you, and then you can go over them with a private consultation to see if you qualify for this 1% down. I think that's a really, really big deal.
Actually, let me take it back. So let's say you buy something for $400,000.
Okay.
400,000. 2% of 400,000 would be 8,000, but they're not going to give you 8,000. They're going to give you 4,000. Right? Max it out at 4.
Yeah.
So you're buying something for 400,000. They give you 4,000. They're giving you one. Then it comes out to 1%.
Got
right?
it.
Right? And then you'd have to come up with 2.
Got it. Got it. Got it.
Didn't
Got
make
it.
sense?
Yeah, but even at 2%, that's a
It's
real,
free money.
It's a huge
It's
deal.
free. Listen, it's free money. You know,
And you can
yeah.
use that towards closing costs and things like that as well.
You can, yeah. I mean, that would be applied to your down payment, closing costs. Yeah,
Awesome.
yeah, whatever.
Awesome.
Yeah.
And I think a lot of people, they know the down payment. Can you tell us a little bit about what closing costs looks like? I think most people don't realize that they have to have down payment and closing costs.
Right. So listen, closing costs include, but are not limited to, right? Title fees, right? Title. What's title? Title. You got to get a title company to insure the transaction, right? It's sort of like, and it's called title insurance, right? So when you buy a house, you want to make sure that the house is free and clear of liens, judgments, violations, somebody else that, let's say it's an estate that's selling the property. You want to make sure that nobody else has rights to the estate other than the person who's signing the purchase contract, right? The sales contract. So a title company, you hire a title company, which is typically hired by the buyer's attorney, at least in New York. You get a title company to do title insurance to make sure that when you take over that home, it is free and clear of all that stuff. Right?
Okay.
So if there's anyone who does come knocking on your door, or there is an open violation or something like that, it's the title company's responsibility, right?
Clear that
so
up.
that's title insurance. You have to pay for that. Right?
Yeah.
Pay for title insurance. You pay for an attorney. You pay for bank attorney. You pay for your attorney. You pay for an appraisal. You pay for homeowners insurance. You pay for mortgage tax, right?
Yeah.
Someone, the city, the county's got to get their tax, right? They got to pick up tax. How do they get taxed? They get taxed from a mortgage tax, right? Sometimes you could have a mansion tax in New York. If you're buying something that's $1 million or more, there's a mansion tax. So there's a number of different. There's escrow fees, right? There's escrows and stuff like that. So there's origination costs. There's bank fees, underwriting fees, processing fees. So all these things are part of the closing costs.
Understood.
And they add up. You know, I just quoted someone today. They bought they're in contract for a $1.2 million two-family house in Queens, and their closing costs, because of course they have mortgage tax of $12,000, not mortgage tax, mansion tax of $12,000, right? $1.2 million purchase. Their closing costs are estimated at about $65,000.
Oh, wow. Yeah.
About $65,000. So you got to, people have to know. You got to know there are closing costs. So now, different parts of the United States, closing costs are different. Typically much less and different than New York City, right? You go outside of New York City, outside of the city, you go to Nassau County, Suffolk County, or Upper New York. They're less, they're less, and other places around the country.
Yeah. I think that's very, very big, because a lot of people, they think they just come in, they have the down payment, and they're ready to go.
Exactly.
And they don't set aside money for that closing cost.
It's our job. I think you and me, more so me than you, because I'm the mortgage loan officer, is the numbers guy,
the money guy.
I'm the money guy. It's more my responsibility to educate. I think our role. We got to be good educators.
100%.
I mean, that's really, I don't consider myself, some people say, oh, you're a sales guy. I'm not. Yeah, okay, I'm a sales guy. But really, I see myself as an educator, right? It's my job to make someone feel really comfortable and knowledgeable about the loan process, so that when they're buying a house, they say, yeah, okay, wow, I get it, And I've been told that like a number of times, like a lot of mortgage, and I'm happy to say that, because a lot of mortgage people don't seem to explain the whole thing, and you've been with
100%.
You gotta, I lay it all out, like this is, and maybe people aren't ready to buy now, and that's okay. You got to set them up for the future. You got to explain how it all works.
Yeah.
Like, knowledge is power. And it gives confidence and makes people feel more at ease when they're going through the process.
Yeah, it was funny that when I think in my career I've benefited from being around you and people who do it right, and it was surprising to hear loan officers when we were out in Detroit this week and talk about the agents that they work with, and the things that they do when they don't prepare the clients for the process, and they don't understand what the process is about, and that just goes to credit to you and to my team with Peter and Roger, that you guys prepare us and you guys give us the knowledge so we're able to speak towards this. So we get the buyers ready for you guys, and you guys have to do less work. No, so but I have to thank you for that.
Thank you, brother.
Yeah,
Well, you
definitely.
know, I really, at the very beginning, I thought, you know, I want to treat, you know, my clients the way I'd want to be treated. Like this is
100%.
a big deal. You know, people are making perhaps the biggest purchase in their lives.
Mm-hmm.
You need to like explain to them, like break it down. What it, and especially most of our clients are first time home buyers, right?
100%.
So
100%.
You got to treat them like, you know, you got to hold them by the hand and you got to take them through the process to make them feel really comfortable, as you would want done to yourself.
Yeah. Speaking of that, what is some of the things you should not do when you're buying a home?
Oh gosh, yes, sir. I'm glad you. That's actually.
Are you going to tell the story about the bike?
About the motorcycle? Goodness
Tell the
gracious.
story, Pete. Tell the story.
You know, it's so crazy. I mean, you know, you think it's obvious, but it's really you have to tell people. You know, you don't want to quit your job, right? Or if you do, actually, you could quit your job. If you quit your job for a job typically in a similar line of work that making you more money, right? If you quit and you get something right behind it, right?
Yeah.
That's okay. But I've had people, you know, quit and, you know, they don't have another job and there goes their, you know, or COVID, unfortunately, when COVID happened, I had people who were, you know, working at hotels and, you know, Uber drivers and stuff like that, and they got shut down and they didn't get the loan. You know, we couldn't give them a loan. But I've also had people, and the person that we're talking about,
We're not mentioning names,
is
Pete.
a guy. No names. Not mentioning any names. But the guy in the middle of the loan he did two things. He started not working. He was a driver. And he started not working when we needed to show that he was, you know, making money.
Yeah.
And then he also went out and he bought a motorcycle, you know, which, you know, not for cash. I mean, he had an installment loan now. And that installment loan killed the debt to income ratio, and he didn't get a loan. And not only did he not get the loan, he got penalized by the seller. He had to pay the seller, like his parents had to pay. I think they had to pay somewhere in the neighborhood of $5,000 to $10,000 because they had already gotten a commitment, and now they couldn't get the loan because the loan didn't work, and I couldn't figure out how to make it work, and they had to pay the seller like you know a sort of what do you call it?
Like not
consideration.
restitution. Yeah.
I was going to say restitution, but consideration for keeping the seller locked up in the contract.
Yeah,
and
yeah,
not
because you
coming
could have sold the
through.
home to someone else. Yeah, 100%.
Yeah.
You mentioned something DTI, or debt to income. Can you explain that a little bit?
Sure. So one of the biggest factors, as you know, that we look at and that underwriters look at in the mortgage business is debt versus income, right? You got to make enough money to support. I mean, we don't want you to buy to go over what's the word I'm looking for? To overextend yourself, right? So what do we look at? We look at your debt versus your income. How much money are you making, and what's the debt the monthly debt that you're carrying, right?
Yeah.
Typically, the rule of thumb, and different loan programs have different debt to income ratios, but on average, right? On average, we're looking at about a 45% DTI factor.
Okay.
Right, 45%. What does that mean? That means if you make $10,000 a month, right, $10,000 a month, $120 a year, then 45% of that is $4,500, right? $4,500. So your monthly carry for your new mortgage and the debt that you have, your student loan payment, car payments, your car payment, credit card payments, shouldn't be more than $4,500 a month.
Got it.
If it's over $4,500 a month, now listen, we can, Freddie Mac, I can go up to 50.49 in some scenarios.
It depends on the program.
Depends on the program. Depends on the
product.
you know, if you're doing 20% down, 15% down, your credit. You know, it depends on a number of factors. But 45 is a good sort of ballpark where you know that a loan typically is going to work, right?
Yeah.
And it's always important to look at debt to income ratio when we're looking at a loan. Yeah.
Awesome. And then I think we touched on the 1% down for the average buyer, but I also know that there's a different program for developers. Can you go into a little bit about that?
The different program. You mean the
contractor.
the one time construction.
The one-time construction loan.
Right. So that's a wonderful program. It's a one-time close.
Mm-hmm,
It's a one-time construction close offered by UWM, and that is and it can be for a primary home. It can be a second home, and it can be an investment home. It can be any of those three.
Yeah.
And what you're doing is you can buy land, and you can do this as a purchase or a refinance.
Oh,
It
wow.
can be a refinance. So you could either buy the land and build a completely new structure, a completely new home on that land, and you get the money for the whole thing.
Awesome.
That's basically it. You get the money to pay the contractor and pay your architect, right, and for all your permits and all that stuff, and then also for the land. So and you get 11 months. You got 11 months to do your construction, to finish your construction.
Do they hand them out in drawers or?
That is exactly correct. So you first, at the beginning phase, the contractor will get upfront money so that they could start the project. And then yes, you're as based on completed milestones. Yes, the contractor will get money based on milestone completions. And of course, there's like a consultant that makes sure that the contractor's doing the right thing, that the bids are they're not outrageous bids, that they're in line with what should be what's appropriate, and also the consultant makes sure that the work is done in an appropriate fashion before funds are released to the contractor.
Got it. And they have to be licensed and of course and insured and everything like that.
Got to have insurance. Got to have a reputation. I mean, there's a whole vetting process, right? You want to make sure, right?
Yeah.
We want to make sure, you want to make sure that you're protected, right? That you have a contractor that has a good reputation and has the proper insurance 100%. And all that kind of stuff.
100%.
And as I said before, it can also be done on a refinance, which means you can actually own the land.
Already.
You can already own the land. If the land has a mortgage on it, right, then that one-time construction has to pay off the mortgage on that first land, right? So it's like a refinance. And we also give you the money to build on the land as well. So you can put up to 1 to 4 units, 1 to 4 unit home.
Anything under 5 is
right.
Considered
If
residential.
you go over 4, now you're into a commercial property.
100%. 100%.